Hey TMFG community, Carlo Cancino here with John Iaconetti, and in today's Ask TMFG episode, John will be going in depth in the value premium. If you do like our content, please do subscribe to our YouTube channel, give us a comment, or give us a like. In today's episode, John will be talking about the value premium. I know that as a client of the McClelland Financial Group, you know our portfolios are made up of dimensional funds. And within these funds, the strategies are pretty simple, but they're more complicated underneath the hood. John's going to be talking about how the things that we do in the portfolio are doing really well right now. John?
Perfect. Thank you, Carlo. So just like you mentioned, today's going to be discussing the value premium and specifically value companies versus growth companies. And you had mentioned it before, working with dimensional fund advisors. It seems like just a globally diversified portfolio, but there are some intricacies within dimensional in how they choose their funds. So I'll take a look at it from an overview perspective, simplify it as much as possible. And when we take a look at it, companies can be categorized into two categories. Value companies, so those companies are companies that are currently trading below what they are worth and thus should provide a superior return going forward. And growth companies, which are companies considered to have potential to outperform the market over their time based on that future potential. So really the value company is the more established, well-known company. The growth company is still that up-and-coming trading based on potential. Now, there's always been a conundrum back and forth with advisors and portfolio managers alike, whether do you tilt more towards the value companies, with ones that are more stable, or do you tilt more towards the growth companies that have potential? And historically, it's been the value companies that tend to outperform over time. Think to some of the more stable industries like the major banks, think towards oil and gas historically. They have tended to perform or outperform a growth stock. However, more recently, I'd say in the last 10 years, growth stocks have actually outperformed due to a lot of those technology companies that we all know about. They're known as the FANG stocks. So it's Facebook, Apple, Netflix, Google, and Amazon. So in the past 10 years, growth stocks have been outperforming, but things have changed more recently. Pretty much since the pandemic, we have gotten to the point now where value companies are back and outperforming. And that could be a lot attributed to current status of the market. Even with high interest rates going up, these growth companies tend to be still expanding and therefore heavily indebted. So just like you and I, if we're in debt and interest rates are going up, suddenly the future cash flows of those companies don't look so prosperous. So specifically, since July of 2020 to actually June of 2022, we're going to be looking at Dimensional's US portfolio and how they've actually outperformed the general markets. So the DFA US Core Fund has outperformed by 3.26% over that time period. And the DFA US Vector Equity Fund has outperformed by 6.61% over that same time period as well. Now, when we're in a period like this where markets have been volatile and typically more to the negative side, while we're invested in a value-based fund or tilted more towards the value side, that's actually made it easier on the drops that we've had in 2022. So therefore, your portfolio hasn't fallen as much as the overall market because you have tilted more towards that value side. So that is the silver lining that we're facing in today's markets. Obviously, we never want to have negative markets as a whole, but if we can limit what we take on the downside, that's only going to make recovery that much easier. And that is what the portfolio strategy has led to, and the value strategy outperforming growth in that time frame.
That's great, John. Thanks so much for that. I think it's important to discuss what the investment strategy is so that clients are aware of what we're doing with their money. It's not as though when the market reacts, we are making knee-jerk reactions as well. We follow an approach that is tested through time and it's documented in the research that's done. And like John was saying, the value premium doesn't always show itself, but it is there over the long term. So John, really appreciate that reminder. That's our video for today. If you did like our content, do subscribe to our YouTube channel. Give us some feedback on the comment section or give us a like. Until next time, I'm Carlo Cancino.
I'm John Yoconetti.
And this has been Ask TMFG.